So here we go. The U.S. added 142,000 jobs last month. That is slightly below economists' expectations. Unemployment, however, fell slightly from 4.3% down to 4.2%. These new numbers are expected to influence the Federal Reserve's highly anticipated interest rate cuts later on this month. The central bank hasn't cut rates since the COVID-19 pandemic began in 2020. So CBS News business analyst Jill Schlesinger is joining us now. Okay, so the number of jobs created wasn't exactly what analysts had hoped for, but is that a bad thing?
Now, first of all, these numbers get revised.
That's true.
Okay, so this is the first estimate. We'll have two more after this. It's within the distance of the 160 that was expected. I think this is pretty much as expected, frankly. Now, the thing that's interesting about this report is that we also got revisions to the previous 2 months.
Yeah.
And those revisions were revisions lower. The reason why this is important is it's very consistent with labor markets that are slowing down. We wanted that to happen.
Right.
It always seems weird, right? You say, wait, why would I want the labor market to slow down? Well, that's part of the Fed's plan. Slow down the labor market, wage growth starts to decelerate, we stop making quite as much money, and we stop fueling inflation. So that's kind of what the Fed really would have asked for in any report.
Right.
Just make it slow. And in fact, we have seen job growth this year slow down 184,000 jobs a month on average. And if you go back to like that crazy post-COVID year of 2021, it was more than 500,000 a month. So we needed to take the steam out of that a little bit.
Slow down slowly.
Yes.
So it seems like by and large, most people are expecting to see an interest rate cut the next time the Fed makes that announcement. It's really just a matter of just how steep it's going to be, right? Is it going to be 1/4 percentage point? Is it going to be 0.5 percentage point? I mean, based on the decision that the Fed makes, what does that say about where our economy is?
We have gone through an extraordinarily wacko 5 years in this economy. And, you know, a once-in-a-generation pandemic will do that.
Yeah.
So to be clear, sometimes we look back to the past as an idea of like what we can expect in the future. I don't think there's really a precedent to what we've just gone through. That said, the Fed's going to look at this numbers and they're going to say, okay, we've got two big jobs, right? Job number one is to make sure the economy grows enough to create jobs. Okay, we're doing that. It's maybe slower growth in those jobs, but okay. Number two, they call it price stability. Make sure that we don't have runaway inflation. The inflation rate is coming down. So the Fed's going to feel like, okay, we're good. We can start cutting our interest rate, our benchmark rate. I think the most likely scenario is 1/4 percentage point at that meeting on September 18th. But, you know, I was talking to a market strategist yesterday, and he said people underestimate that if the Fed feels like they're not ahead of the game, if they really think they've got to do more, they will. Don't forget, we saw the Fed jam up interest rates when they were behind.
So true.
They could do the same on this side of the cycle. So this will be the first of many interest rate cuts. We're not going back to zero, gang. You're not going to get a 2% mortgage anytime soon. But we are going to slowly get to more normal interest rates.
It seems to me like this particular group of decision makers at the Fed, that they are a cautious bunch. I mean, I guess they're always cautious.
Yeah.
But it seems like the slogan is slow and steady in either direction.
Yeah. I mean, look, Jerome Powell is not, he's the Fed chair. Yeah. He's not an economist, right? He is a lawyer. He is a manager. He is a consensus builder. And they all have the same information. Some of them come at this from different angles. And I think his angle is, hey, he doesn't want to say it out loud, but, you know, we were late in starting to increase interest rates. And we really didn't want to see inflation bubble up again. And so he just gave a speech in Jackson Hole, Wyoming last month. And he essentially said, we're going to start in September, and it's going to be data dependent. But he shifted something very interesting. We've been talking so much about inflation for the last few years. In that speech, what he said is, hey, we're going to do whatever we need to do to support the labor market. And that was a big change because they have this dual mandate, jobs, inflation, right? He's saying, I think I got the inflation thing covered. If jobs start to deteriorate, if we start seeing widespread job losses, and by the way, last month, 24,000 jobs lost in manufacturing, 11,000 jobs lost in retail. You know, we saw construction up, we saw healthcare up, but, you know, we are seeing a little bit on the edges, some sectors starting to peel off jobs. He's saying to us, don't sweat it. If things get bad, we're going to cut, and we'll be more aggressive if we need to be.
Very interesting. And you know him. I mean, every syllable is very deliberate.
Yes.
He's always sending a message. Jill, thank you very much.
Sure.